Hello everyone, Clifford Bennett, Chief Economist at ACY Securities. Apologies for the casual clothing today. Running a little bit late for the airport, don't have time for the shirt and tie. So let me get going here with some hopefully very valuable content for you. That was a fabulous retail sales number out of the US last night, and we were expecting a good retail sales number out of the US last night. But up 0.7%, almost double expectations, which were 0.4%. This number was greatly inflated by the big Amazon sale day, and just tremendous, massive sales effort on sale items all around the country during July, as well as July being a very strong travel period. So this is as good as it gets, to take away from that famous movie, as good as it gets. If you haven't seen it, Jack Nicholson, make sure you do watch it. And the worry is, I actually have the possible expectation that all of that gain will completely evaporate in the August month. I mean, if everyone's gone and grabbed things on sale, they're not going to continue shopping with the same frenzy the next month. So August, the next month's data could be particularly worrying. Now, on top of that retail sales number, then we got things like, well, inventories were flat, so it's reasonably neutral, but inventories have been wound back quite a bit, and that makes sense in a slowing economy that a lot of businesses have done that, but they were flat on the month, nothing there. But over in the Empire Manufacturing Index, the New York Empire Manufacturing Index, another catastrophic number of -19. Now, I've been saying all year, manufacturing is in recession. You hardly ever hear anyone else say it, but it's so apparent. It's in all the data for manufacturing. So yes, manufacturing, diabolical state in the United States. So that wasn't good for the market. And then the other thing that happened was the NAHB Housing Industry Index had been showing signs of recovery. It was still well down within those COVID lockdown territory areas. So it was still not good, but it was moving higher. But unfortunately, it just had a rather steep fall from 56 to 50 in August. So again, another bad number. There was a positive number for the United States in terms of capital inflows, $147.8 billion in the most recent data for the month. And that is obviously part of the reason why the US dollar is strong. But one of the things I've been mentioning quite a bit, but doesn't get enough airtime, is that terrible total deposit guarantee for the too big to fail banks. Not only is it savagely distorting regional banking, and by the way, it's dropped away from the headlines. There's a lot going wrong in middle America at the moment. But so the regional banking sector is still being hammered, and there's billions of government support going into it. So that's a real hidden story that is not good either. But that guarantee of deposits for the too big to fail banks is actually distorting global capital flows, because if you're a US corporation, why would you have cash sitting in a bank in Europe when you can have it sitting in a bank in the United States fully guaranteed? Of course you'll move the funds there. So, and other investors and corporations around the world are saying, well, let's open an account with, one of the big banks in New York City, and our deposits, regardless of what happens to the economy or geopolitical events, are fully guaranteed by the federal government. I mean, the federal government's guarantees on deposits must be skyrocketing. So all of this with a massive fiscal and trade deficit, where does it all end? But anyway, that's why the US dollar is going to be a little bit strong. But all of that economic data together really did sink stocks on the day, and they are doing that breakdown I've been warning of. We called the first decline, we read the consolidation, I've been warning there can be a further decline, and it looks like we're truly on the precipice of another fresh down move in the equity market. So really be cautious here. Don't be cautious on the short side, maybe take an opportunity there. But if you've only got a long equity portfolio, do think of all the massive financial instruments you have literally at your fingertips to protect that portfolio. You may not want to sell out of all your stock holdings, but you can hedge them with the instruments available to you. I just really think people should be playing defense at the moment and take a good look at the market. I hope that helps. Have a great day. Clifford Bennett, Chief Economist, ACY Securities, off to the airport. All the best.